In PIMCO's annual secular forum this September, we concluded that while cyclical recovery will likely continue over the next year or two after the steep drop earlier this year, there are 4 macroeconomic disruptors that could potentially become even more pronounced over the secular horizon. China's rise, populism, climate-related risk, and technology. China's rise as an economic power has encroached upon higher value-added producers elsewhere in the world, and is at the same time calling into question the established geopolitical order dominated by the US. We think this trend is likely to be accelerated, given the country's earlier and stronger rebound from the pandemic, and its strengthened focus on its strategic growth plan. Populism is likely to be fortified by the pandemic recession and its impact on rising inequality along several dimensions. We expect this will lead to increased protectionism and nationalism. Climate-related risks are real. Their effect on human lives and economic activities became even more apparent this year. There have already been incidents of catastrophic environmental events. As an investor, we have to factor in additional governmental responses in the form of regulations, carbon taxes, and other decisions that impact fiscal policy, capital flows, and asset prices. Technology was already identified as a beneficial yet also disruptive force in our secular outlook last year, and the additional economic prowess the technology companies gain during the crisis will make them an even more formidable force. Successfully distinguishing the winners and losers from digitalization will be an important source of alpha for active investor over the secular horizon. China has recently unveiled a dual circulation economic strategy. While some may view China's long-term attempt to reduce its dependence on overseas markets and technology as reverting to a closed-door policy, we believe that it reflects a strategic adjustment in response to a more contentious geopolitical environment as the US-China tensions escalate and protectionism rises across the globe. Although a forced financial decoupling is not our base case, we believe China will accelerate the internationalization of the renminbi to mitigate potential disruptions of international transactions and further opens its financial markets to foreign investors. The PBOC took swift and preemptive monetary easing measures in early 2020 in response to the COVID crisis, which should allow it to become more balanced as the economy recovers. In our view, a near-term rate cut is unlikely, given China's solid recovery, already accommodative credit conditions, and the PBOC's active approach to liquidity management. There is a clear divergence of economic and market performance in Asia, with 3 distinct groups driven by varying effectiveness of pandemic containment, underlying economic structure, and policy room determined by the initial conditions of their respective sovereign balance sheets. Tourism-dominant economies such as Thailand, Sri Lanka are most affected. We are underweight on Thai baht and cautious on Sri Lankan credit in our portfolios. For Indonesia and India, where the pandemic is still not contained and at an elevated stage, we are worried about the depth of recession, given the fiscal policy constraints and negative pressure from a sovereign credit rating if sustained. China, Korea, possibly Singapore have acted early to contain COVID-19 by effective policies. Their strong manufacturing, export, and tech supply chains benefit from a strong V-shaped rebound. Balance of payments is strong with FX reserve accumulations. Policymakers also have ample stimulus room, even after the fiscal and monetary stimulus so far. Economy seems to be on a solid recovery trajectory here. In particular, we are positive on the renminbi, which should continue its appreciation trend and attract portfolio flows. We think China onshore government bonds potentially should serve as a decent source of duration and provide potential portfolio diversification benefits as they gain wider adoption in bellwether indices.